Hello again, Investing Pots back with you after a long delay caused by the renovation of my office. So I've been trading a $25,000 account on Robinhood for about 6 months. I've tried a bunch of different things, but I kind of settled on a list of priorities. What am I trying to accomplish? First of all, my main objective is to beat the index. And by index, I mean a simple 60-40 SPY bond split, which is kind of a brain dead portfolio that requires very little interaction other than a rebalancing periodically. I have enough money that I don't need to YOLO a $5,000 account and go for a moonshot. If I can match or beat the index and limit my downside during the downturns, then I'd feel confident that I can grow my entire portfolio in this way and kind of scale the strategy up. Secondly, I want to meaningfully diversify to minimize the correlation between positions and the overall volatility of the portfolio. Certainly the SPY and a bond ETF are negatively correlated, but there are other asset classes that are not highly correlated to either stocks or bonds, specifically precious metals and commodities. Thirdly, I've decided that I prefer options to owning shares. Specifically, I like to trade the poor man's covered call or poor man's covered put. To trade the poor man's covered call, you buy a deep in the money call that expires far in the future. This option behaves almost exactly like 100 shares of stock, but at a fraction of the cost. Like for instance, to buy 100 shares of SPY would cost you about $42,000, whereas I can control I can buy a deep in the money call for about $63, I think. So then you sell shorter dated calls against the long call. So I like the poor man's covered call because you cap your downside in a crash. So if the stock crashes, you can only lose the cash that you used to buy the long call. In a crash, the extrinsic value of the long call will go way up. So even if it goes to nearly out of the money, it'll still have a lot of extrinsic value. That further limits your downside if you choose to sell the long call. I also like the poor man's covered call because you have a very fine control over the hedging. Like for instance, if you think that the stock is overvalued, you can sell in the money calls, 60 delta calls against your long call. Or if you think the stock is going up in the short term, you can sell further out of the money calls, like 30 delta calls, to give the long position room to run. So one disadvantage of the poor man's covered call is taxation. Essentially all your trading gains are taxed as a short-term capital gain unless you buy long calls that expire more than a year in the future and before you roll them, which I don't really like to do. If you had a portfolio of stock and you held more than a year before selling the shares, it's taxed at the lower long-term capital gains rate. So for people in a high tax bracket, that difference can be really significant, unfortunately, for options traders. So here's a comparison of my previous portfolio. This is what I was trading up until about a week ago, versus the SPY and versus the 60-40 SPY bond mix. It looks like I'm basically tracking the SPY with some big drawdowns, both of which occur at earnings, where a few positions went against me and I lost a lot of money. So unfortunately, I failed to account for the value of my short options when I reported my portfolio values. So this curve that I just put on here, the thick red curve, is the actual portfolio value from Robinhood, and I plotted it here. So, from January until June, I basically tracked the SPY. Since early June, though, my account took a nasty beating. So what happened? I screwed up some earnings trades last week, as I said, but a lot of the problem was just single stock risk. I was trading 12 stocks, and a lot of them were mid caps, even small caps. 12 is a lot, but it's nowhere near as many as 500 in the SPY. So a drawdown in one or two stocks can really affect your portfolio to the downside. And since June, the momentum has just rotated away from small caps and reflation stocks like oil and commodities back into tech, basically. And if you recall that, yes, the S&P 500 has 500 shares, but it's not equally weighted. About 25% of the SPY consists of the huge tech companies. So yeah, when you buy the SPY, you are buying tech. So you can see a list of my previous holdings at the time when I abandoned them. I'm not going to list them individually for you, so just hit stop if you want to view all the individual positions. I was shooting for a 3 to 4% allocation in each stock, and you can see how this did vary wildly because of the single stock risk. But since June, most of my shares have fallen, as you can see. So anything related to commodities or industrials has gotten hit pretty badly in the last month. So here's a list of my new holdings. It's a much simpler portfolio consisting of the SPY, TLT, which is a 20-plus year Treasury ETF, GLD, which is the gold ETF, DBC, which is called a diversified basket of commodities. DBC is actually about 60% oil and natural gas futures, but it also has positions in agricultural commodities as well as industrial and precious metals. I also hold IWM, which is the Russell 2000 ETF. Yes, this is another diversified stock fund, but the correlation between IWM and SPY is actually pretty weak, only about 0.75 right now. So by owning the two different ETFs, I do get some reduced correlation a little bit. I got 10 shares of Outbrain, OB is the symbol, in an IPO, and I asked for 100 shares, but only got 10. So this is worth $200, which is basically a rounding error. And importantly, I aim to hold 40 to 50% in cash. And in most people, if you're trading in a typical long stock portfolio, you do not go for 40 to 50% cash. But if you're an options trader, be mindful that options are far more volatile than shares themselves. So you need to be careful that your portfolio doesn't go to zero in a crash when you have options. I'm trading the poor man's covered call on all these equities. My goal, as I said, is to beat a 60-40 SPY bond portfolio with less volatility, especially in the big downturns. So we'll see how it goes. Would love to hear your comments or questions. Otherwise, I'll see you in the next video.